Welcome everyone to Nebraska Farm Bureau's Inside Profitability webinar. I'm Jay Rempe, Senior Economist at Nebraska Farm Bureau, and I'm hosting today's event. For those of you that haven't been on one of these before, the Inside Profitability series is a series of webinars and podcasts that are designed around topics that are identified as essential to producer profitability. What we think makes this series unique is these events, the topics that we cover are recommended by our members. And there's just ideas that they come up with as they're on their farms and ranches day to day and think, hey, I'd like more information on this, or I think this is key to managing a profitable operation. So I want to learn more about this. So please, if you have any topics or ideas or things that you would like us to cover, please shoot me an email at jayr@nefb.org, and we'll try to get it covered. And our goal again is to be informative and provide you with information that you think will be of value and help managing your farm and ranch. So our topic today is inflation. It's very much in the news. It's at the top of the mind for consumers and producers. And one of the unique things about the inflation levels we have now, we haven't seen them for quite a while, since the 1970s and 1980s. So there's a lot of people, both farmers and consumers, that haven't had to deal with a period of high inflation. Unfortunately, I hate to admit it, but I'm old enough to remember the inflation from the 1970s and 80s. But today we're going to focus on what inflation means to agriculture and what it means to farms. And this topic was suggested to us by a farmer member who farmed during the 1980s, survived, managed to get through it, and it has a successful ongoing farming operation today. And he sees evidence in today's economy of some of the things that were happening back in the 1980s, and thought it would be good to focus on this topic. So today I'm excited. We have two guests to talk with us about this topic. My first guest is Krista Swanson. Krista comes to us from Illinois. She's a research analyst studying farm economics and policy impacts on agriculture for the University of Illinois, where her work is frequently published on FarmDoc, the website. And that's where I first saw some of Krista's work. In addition, she and her husband own and operate a seed business and actively farm with his family, where they raise crops and have 4 kids. And she also has previous work experience in agriculture tax accounting and loan portfolio analysis. And on top of all that, she enjoys speaking to groups, and she likes to talk about how economic principles tie into life, leadership, and purpose through her business ag scope. So Krista is a very busy person, and we're very glad that she was able to join us this afternoon and talk a little bit about agriculture and inflation. And so Krista, I will turn it over to you.
Okay, thanks so much for that introduction, Jay. I thought really when we're talking about the current situation, there's really no better place to start than what is inflation. And so inflation indicates a rise in prices, but more specifically, it's the rate at which prices for goods and services rise. In other words, it means that there is a decline in the purchasing power over time, or how far that dollar will go at the grocery store or the gas pump. We don't use inflation to describe a situation when there's a rise in the price of a single good or service. Inflation is looking at a large and diverse set of products and services, and this includes things like food and fuel, electricity and transportation, even healthcare and entertainment and other services like that. So if you can imagine that you could fill a really huge basket with all the goods and services that you use regularly, and then think about how the price of that filled basket changes over time, that's how inflation is measured, if that basket price is increasing. One of the most common ways to measure inflation is with the Consumer Price Index. And this is an index that's updated each month by the US Bureau of Labor Statistics. And it's looking at how the price for that basket that I just talked about is changing over time. And when we hear this referred to in the news, what they're referring to is a rate of change, a year-over-year rate of change. So the July 2022 inflation value that I've been hearing a lot of 8.5%, what that means is that the price of that basket increased 8.5% from July 2021 to July 2022. So I just wanted to explain that a little bit to have a better understanding of what we're talking about when we hear these numbers, what they really mean. And So the United States actually, and as Jay already pointed out, we are at the highest level of inflation since the early 80s. And since 1983, from 1983 to 2020, the inflation rate averaged 2.6%, which is a fairly low or moderate level. But since 2020, things have been anything but normal. And there are a number of explanations that can be given for why we have these high inflation levels and why is it high and why now? One of those reasons is we had the COVID pandemic, and not only the pandemic, but also the responses, the economic responses that came from that, such as shutdowns. It led to a recessionary period in which consumers weren't spending much because they were staying home and not doing much. So spending slowed and savings increased. And then as the nation reopened, we had this pent up demand and people were ready to get out and spend. And so we had this, high level of spending all at once as things opened back up. The pandemic also caused supply chains disruptions, which I think those of us in agriculture realize that as much as anyone. And this is sort of a two-pronged thing. We had early on in the pandemic where we had supply chain problems with issues such as, the packaging for milk that would have went to restaurants and schools. All of a sudden we needed that milk, but we needed it in gallons or half gallons on grocery store shelves. And so the supply chains and the normal production and distribution methods had to adjust. And now we're kind of facing some of those same things again as consumers change some consumers change some of their habits. And as we're coming out of the pandemic, patterns for purchasing have changed a little bit. And so we have the supply chains now working to adjust to this post-COVID consumer demand. We also had federal government spending. So if you remember the stimulus packages in 2020 and 2021, government spending in and of itself actually contributes towards inflation. But these packages also included direct payments to individuals and money for small businesses. So that put money in the hands of people and businesses that were then able to go out and spend. And we have an energy situation, which is kind of a challenge of government policies that changed how we want to utilize energy and what sources of energy we want to utilize. And we, of course, also have the Russia and Ukraine war happening that has definitely changed the normal trade flows of energy and is contributing to some shortages, backups, and overall higher prices. We also have continued high global demand for food because we still have a world full of people that need to eat. And then we have high labor costs as employers are raising wages to attract workers. I think this is another thing that those of us in agriculture understand as well as anyone. It is very difficult right now to find labor and pay enough to attract workers and keep workers. And that's something that employers across the nation are facing. And that leads to what we call labor wage inflation, which generally translates to higher general inflation. So we have, this is a whole slew of components coming into play right now that are contributing towards the inflation that we're seeing. And so when we talk about inflation, we think about a little bit of a correlation with interest rates. If you think about inflation as a condition to be cured, so once we get to an inflation level that's too high to be sustainable, we need to do something to fix it. So you could kind of, as an analogy, think about it like if you have a sickness that needs to be cured. One anecdote for this condition is Federal Reserve action to raise interest rates. So interest rates are a tool a policy tool used by the Federal Reserve to control inflation. And the higher the cost, so the reason that interest rates works as a cure for inflation is that it makes the cost of obtaining money higher. And the higher cost of money reduces purchasing power, which leads to this chain reaction of less purchasing and reduced demand and lower prices. So referring back again to the 1980s, which was the last time we saw inflation rates at this high, and in fact, even higher than they are right now, interest rates and inflation tend to move in the same pattern, but interest rates lag movement because they are generally a policy tool used to move inflation in the direction that is desired. So in the 1980s, we see a clear example of this where inflation was moving upward, and then interest rates followed the same trajectory a little bit later. And as interest rates were increasing, again, action by the Federal Reserve, inflation started to decline. So this also kind of serves as a reminder that in agriculture and on the farm right now, we don't like seeing higher interest rates as the Federal Reserve slowly raises those rates so far throughout this year and expected to continue. But it is a action that has worked in the past, and we can see that, and hopefully should work this time as well. And so thinking about this environment that we're in with high inflation levels and rising interest rates, what does this mean for agriculture? And what it means is we have upward pressure on the costs of a lot of things. We're seeing upward pressure on capital asset values, and that includes land values and property and machinery. So if you are in the market for purchasing those sort of things, the markets for those are pushing higher. On the bright side, the resale value of assets is also high. So if you're in a position where you are making a trade, at least as some consolation for the fact that you're spending more for a piece of machinery than you were a year or two ago, the item that you're trading in also has increased in value. And that's also a positive thing. I'll talk more in a minute, but going on the resale value of assets, important to think about if you have any excess things, now is a good time to sell those. We're also seeing upward pressure on interest rates, as we just talked about. There's a reason for that. That's being done as a purposeful move by the Federal Reserve, trying to control inflation. But what that means is that the cost of borrowing is higher, and often farmers utilize borrowed funds to operate. We also have upward pressure on production inputs. This includes fuel, of course. We're seeing that particularly noticeable in fertilizer, but really across the board, there's upward pressure as the input retailers, it's costing more for them to do business. Agricultural services, also there's upward pressure on the prices of that. What this means is if you are hiring application of fertilizer, chemicals, or trucking, those services are more expensive. And but finally, as I focus so much here on the cost side, I also want to point out that it's also putting upward pressure on commodity prices. And so one thing to always keep in mind is that as long as things are moving in at relatively the same pace, then it's not necessarily a negative in terms of profitability, but definitely something to be a diligent manager and watching those things. And that kind of brings me to my important notes, is that some prices of some items go up faster than others, and some are more slow to respond. And the same is true on the way back down. So when prices are in a high price environment, at some point, we're going to see some relief on that. History shows us that we tend to see commodity prices declining before those expense items. And so that's also something to keep in mind as we think about managing right now in this environment. So there are some challenges that farmers are facing right now at the onset of this planning season for 2023 year. And one of the challenges right now is that we're in the midst of the treatment. So I mentioned earlier where you could think of inflation as an ailment to be cured, and the Fed rising interest rates as sort of the medication or the antidote. So if you would imagine that you had a sickness and were taking a medication that caused some side effects, but your original ailment wasn't cured yet. So you're in this position where you still have the original problem, but you've also got some side effects going on. That's sort of like the situation that we're in right now. We still have the inflation that we're trying to cure, but we also have the higher interest rates that we're facing. So it kind of feels like things are hitting us from all angles. And so in that time, I'm going to present a few strategies for managing in the current economy. So one of those is maintaining liquidity. If possible, keep larger reserves of cash than you may otherwise have. So a lot of times farmers will use any extra funds to pay down long-term debt. Sometimes they use it to make capital purchases. But I feel like until 2023 input costs are clearer, maintaining that extra liquidity, keeping it accessible can be a good thing before moving to some of those other steps that we would normally move to, like paying longer term debt. Another strategy is considering interest rates on term loans. So if you are taking out a new term loan, work closely with your lender and maybe study what the Federal Reserve is putting out there. I feel like this is a little trickier right now at this point in time than earlier in the year, or maybe even later in the year. Earlier in the year, it was very clear that interest rates were going up. So it seemed like a good time to lock in rates on term loans. The Federal Reserve's most recent information sort of indicates that they plan to continue increasing throughout the rest of this year, and with hopes that maybe in 2023 they can start lowering. So that kind of doesn't really give us a clear picture on if it's a good time to lock in rates or not a good time. You can also do short-term locks that give you the opportunity to keep the interest rate that you have now for a period of time, and then reset that in the future. So again, working with the lender and figuring out what's a good interest rate move at the time. Machinery efficiency is another strategy to consider in managing in this economy. So we did a FarmDoc article series on this a couple of years ago, talking about really making sure that the machinery line is in line with the acreage that you have, that you're basically not over equipped. And now is a good time, especially with those resale values, if you are over equipped, and it would make sense to downsize, which I know is not applicable to everyone, but it's still an important thing to watch and may be something that can help someone. Optimizing labor, if you have labor on your farm, ensuring that it's being used to the max for what you're trying to accomplish. Testing for fertility needs, so is another strategy. So we, as farmers, and I can speak for myself here too, we like to get high yields, and oftentimes we fertilize with that yield in mind, instead of paying attention to maybe what a soil test says, or thinking about our fertility needs. And in this high cost environment, it can be financially wise to make sure that the fertilizer that you're using and the amounts that you're applying are the optimal from a profitability standpoint versus a yield standpoint. Evaluate production possibilities is another strategy. So what this means is, on your farm, you probably have multiple products that you could produce. You might have a normal rotation or some livestock involved, but thinking about what the market is indicating in terms of prices and costs, and maybe making some adjustments to what you would normally do. And I know there are challenges agronomically and in other ways to making changes, but if the market is sending strong signals, that's always something to keep in mind. And then kind of moving to number 7 is selling 2023 grain when purchasing 2023 inputs is another strategy to consider. And what this means is that we don't really know what trajectory input costs or grain prices might follow over the next over the next year. We're kind of moving into this season in the fall where it's time to be purchasing 2023 inputs, or a lot of farmers who buy ahead. I mentioned earlier that often we see prices of the commodities that we're raising and growing fall before we see the prices of our expense items fall. And so the concern is if you lock in prices on inputs early and don't make kind of a correlated sale of grain to cover those costs, and then we see our commodity prices fall off, we are now left with a crop that we're selling at a lower relative price. And I realize these don't always move in the same direction, but it's still something to think about. Maybe sell and buy at the same time that you're in sort of the same price environment or the same economic situation. And so that is where I was going to wrap up what I had planned. And Jay, if we want to continue the discussion from here.
I saw a commentary by someone talking about some of the generational differences as we look to higher interest rates and debt levels and those. And it was along the lines of, we mentioned the 1980s, and the farmers that made it through the 1980s, their response to these conditions are a little different than maybe the younger farmers that haven't gone through a period like. Are you seeing that, or it's in some of the, I guess, people's views on debt levels and interest rates and the like?
Yeah, I mean, I think it's not really a fault necessarily of the young people because they just didn't live through and experience that. But I mean, really anyone under 40, even 45, probably doesn't remember the pain of agriculture in that time. And I myself fall into that group. And I think that those of us who have only really been farming, my husband and I's first year farming was 2012, like officially us farming some on our own. And, those years since then have all been relatively good on a historical scale. And so if you think about that, we haven't, younger people haven't really been through some of those tough times. I will note that as we can make some correlations to the similarities of this current period, when we look at inflation and some of the fears of those things that we can link back to the 1980s and say, hey, this is kind of similar to what we were facing then. There are a few differences that I think are really important to note. One of those is the difference in debt to asset ratios now as compared. So when we were going into that high inflationary period and the period in which the Fed started to increase interest rates back in the late 70s and early 80s, the debt to asset ratios then were much higher than what we had now. We also, although for younger people like me, these interest rates seem high, they're actually historically still quite low, and which is in contrast to what we saw then. I mean, if you look at what's coming out of the Federal Reserve, I alluded to this earlier, but if you look at what's the information that they're putting out as to what their plans are, does not indicate us getting anywhere near the interest rates of the 80s. So I think there's some comfort in that as well. Another thing that's different, and this is, I know, only applicable more so to the crop side of farming and ranching, but we also have a way more robust crop insurance program now than we did at that time that can provide some relief or assurance. Risk management protection is what I'm looking for here, much differently than what crop farmers of the 1980s were facing. So just wanted to point out that as much as we can draw those comparisons, and it should be a wake-up call for younger people who haven't been through this, definitely need to have a sense of awareness and maybe talking to those older farmers who lived through that and came out better for it. But at the same time, we do have some very important differences.
That's an excellent point about the crop insurance, Krista. That's one I haven't heard somebody make before, the differences in the programs now that existed between now and in the 80s. So
yep,
that's a good thought. Just one last question, and this may be a bit unfair, but a lot of people out there thinking, how long is this high inflationary period going to last? And you alluded to that a little bit, that you don't see the Federal Reserve interest rates getting up to, or they're forecasting or broadcasting that they're not going to get as high as they have before. Any sense from your vantage point of how long this inflationary cycle will last?
Well, I'm just going on the information that they're putting out. I mean, what the Federal Reserve is indicating from what I've read is that they plan to continue increasing interest rates a few more times this year. I think part of it also depends on what kind of reaction we start to see in inflation. So again, the whole purpose of raising interest rates is trying to curb inflation and get it back down to a more moderate level. And so if that starts to work sooner, then I can see them backing off interest rates sooner. If it's not fixing the problem, then they might have to keep going. It seems like right now they're indicating that as early as middle of next year, they could even start being in a position where they are lowering interest rates. Those are just what they are saying right now. It just really depends on if inflation is reacting to the higher interest rates. And the challenge that I think is different in the current economy, I talked through all those contributors towards the inflationary period that we have right now. And, some of those are still ongoing battles. And so even if we're making efforts to curb inflation, as long as as long as the war in Russia and Ukraine is continuing, as long as supply chain is still working out its kinks, as long as we still have some of these things happening, we could continue to still see inflation, not budging as much as we would like it to.
Okay, well, thank you very much, Krista. Unfortunately, that's all the time we have today. I think we could carry on this conversation for a lot longer. So my second guest today provides a little different perspective on the whole issue of farming during times of high inflation and rising interest rates. Having farmed during the 1980s, the last time agriculture saw or experienced circumstances similar to what we're seeing today, he's got a unique perspective, I think, on what's happening today with farming. So my guest is Don Cantrell. Don is from Myrna in Custer County. He was a young producer during the 1980s, and he made it through the 1980s, and today with his son is part of the successful family farming operation. And Don joins us today to talk a little bit about his experience and what he learned and how it could apply to today's conditions. And Don, thank you very much for joining us. I appreciate you taking the time to do it. So let's get started. Just tell us a little bit about your experiences during the 1980s and farming during that period and during that time.
Okay, I went to the university for 2 years, got an ag certificate. I was going to go for a degree, but a 4-year degree, but decided not to. We got married in 74 and started farming then. My dad died in 1977 from a tractor rollover. My mom died 2.5 years later from breast cancer. And that really set up a disaster for our operation because I'd started buying land. I think I'd bought 3 properties. And in 1985, when it was the worst of the worst of the 1980s, the bank told me they would loan me half the money that I needed to keep farming. And I was 32 years old. I wasn't giving up anything. So we had a very, what I considered successful operation, although it's fairly small compared to what we are today. And so I went to somewhere between 10 and 12 other banks, got turned down by every single one of them. I had a quarter and an 80 free and clear but I had debt on the other land that we had purchased, and I couldn't borrow a dime. I couldn't borrow anything from them. And at that point in time, in my opinion, the regulators were the problem, the bank regulators. They made it a much worse situation than what it needed to be. They had those bankers so scared to loan any money because the regulators would be on them. But they just basically quit loaning money. And so it made it much, much worse. So one of the things I learned is when a banker is scared or he's in survival mode, and he wants to keep his job, of course, and you can't blame him a bit for that. But all they care at that point in time is getting the bank's money back. How it affects anyone else doesn't make a dime's worth of difference, because they've got to perform their job. They've, of course, got bank owners to answer to and directors to answer to. And so I had no idea that. I thought, I got land free and clear. I can always borrow money. Well, it changed. So now I borrow almost all my money against my land. It's set up on 20 and 30 year. And then, of course, we've got it at low interest rates. We were able to lock everything in at very low interest rates compared to today. And so we don't borrow a lot of operating money. And that's just extremely important. So the reason it, with my folks dying, they had a very successful operation. They owned, let's see, it was a little over 1,000 acres. Well, there were 4 of us in our family, and so it was split up 4 ways, as it should be. Well, there was no equity for, if my mom would have been alive, the 80s would have been tough, but not nearly as tough. I've got a friend who graduated from high school with me, who was doing just what I was. He was buying land and getting going. And if you asked him what the 80s were like, he says, it was just a blip. He says, we were able to buy some land cheaper because the price, but he says, we just kept on buying land. Well, his folks were alive, and in fact, they just died a couple years ago. So they lived for another 40 some years, which is great. But that land base and was what was the difference. So
yeah.
So
at the time, do you recall kind of land values when you were going through that tough stretch and trying to find somebody to loan you money? Were land values going up then, or had they turned around and started going down? And where were interest rates at that time too?
Down. They were down. The land prices were down probably half of what they were before, and at least half. And so to finish up on my story, what I did after I was turned down by all those banks, then I started going to neighbors. And I went to my dad's best friend, and he said, well, we've loaned money to people over the years. We've kind of got out of the habit of doing that. But if you can't get the money anywhere else, come back. So I had an pull. So I went to another neighbor, and he said, oh my gosh, he says, you're a good farmer. He says, if we lose all our good farmers, it'll just be a disaster. So he loaned me $125,000 on I think it was a 3-year note on the quarter that we had. Interest rate was 13, which he gave me a heck of a break, because at the bank it was around 18 at that time. So it was a win-win for him and me both. And I paid him off. Then I got a FHA loan on the equipment. But like, to show you how bad it was, the bank wouldn't allow me to make my federal land bank payment. And it was like a $15,000 payment, which more money than it is today. But they wouldn't allow me. And I said to Federal Land Bank, why don't you loan me money against this land? And they said, well, we'll loan you the amount of what the payment is. And I said, I'm not going to tie up a quarter of ground for $15,000. So we didn't do that. But anyway, got this FHA loan on the equipment. And then in 1988, things were wonderful. Price of corn went to $3.20. And I had 3 years of crop in the bin because they had the reserve program. And that was really a savior for me. We were getting 25 cents a bushel and on all that grain. Mm-hmm. And then one of the best programs they've ever had as far as, because it forced you to sell it when price got high because you had to pay the loan back if it got over a certain price. So I got mine sold at $3.10. I didn't hit the high, but I got within a dime of it. I just sold all of it. And then I went to I had my debt down a great deal at that point in time. It's amazing when you're in fear mode, when you can't sleep every night, you spend every waking hour of how you save money. Mm-hmm. It didn't take much for us to live. My wife was on board that we were going to get this thing back on track. We didn't buy any new equipment, which they wouldn't allow you. The odd thing about back then, the bankers would loan money for repairs, whatever you needed for repairs as you visited with people, but they wouldn't loan you money to buy new equipment. And then I switched to a different bank because I was mad at that bank, and I don't know if the bank I went to would have been any different or not, but I've been at this other bank for ever since, and along great. So
I'm just curious. It's the first time that I've heard of farmers going to neighbors to help them financially in terms of a loan and stuff. Was that unusual at the time, or was that pretty common?
I was sure it was unusual, but we live in an unusual neighborhood. We had some really wealthy farmers.
Okay.
Like I borrowed the money from. He was farming full time, and his son had just was a couple years younger than I was farming full time with him as well. But they owned 4 McDonald's restaurants in California. Mm. They had a lot of investments, and they over the years had loaned money to people, and so had the other neighbor, and I knew him very well, and they could see what kind of a farmer I was.
Yeah. So you've already hinted at this, Don, but when you said that you very rarely or use an operating loan and you try to keep all debt tied to your land, any other, or could you elaborate on that a little bit, or any other thing that you took from that experience that informed your management decisions for the rest of your farming career, or that you took away from that experience?
My son calls me, to his friends, he calls me Papa Bear. Mm-hmm. And says, well, Dad, he's always looking at what can go wrong. And he always has 2 or 3 plans of what he's going to do if that happens. So to give an example, we bought a I don't remember how many acres it was, 4,000 acre ranch or something like that here a few years ago. And I told my son, this is a big deal. I mean, it was a 4.2 million is what we gave for it. I said, this is a big deal. And it took him quite a while to talk me into it. His passion is cattle, my passion is corn. I said, okay, what pivot irrigated quarter that you own are you willing to sell if this thing goes bad on us? And he looked at me, and I said, I'm serious. What would you give up? So the next morning he came and he says, so-and-so quarter. I said, okay, I'll go ahead and do it. Mm-hmm. Let's see what we can do. And I just wanted to ingrain in him that if this goes south on us, we'll part with whatever we need to. So where I learned that from was from another neighbor, one of them that I'd asked about money, but this guy was a hired man, started buying land and farming on his own in the late 60s. In about 25 years, he put it together 3,000 acres of farm ground. Just an amazing success story. Well, when the 80s hit, he sold off a couple pieces of ground and then rode right on through it. I'm sure it was tough. I never heard any details that it was tough. But then once good times started coming back, he started buying ground again.
Hmm.
And when I couldn't understand where the bankers were coming from. So I got the opportunity to be elected to the Federal Land Bank Board. And so I thought, I'll get on and figure out how this works. I don't understand it. And I didn't, I figured out that the regulators were a big part of the problem, in my personal opinion. But so I end up being on what they call a credit review board, and all that we're on for different people. Well, this is the last step before a person is sold out. And so we go into those meetings, meet with that producer, have a couple loan officers there, and they were crying and they were beat down and they had lost everything. When they got to that point, they had nothing left. And the thing I could see was, if they would have typically sold some ground, and they'd have been able to ride through it, but they wouldn't do it. They just kamikazed it right into the ground. Mm-hmm. And that's why I feel that you always need to have a plan of, what are you going to do if things go bad? And we've never had to sell any ground. The worst part about being in a farming community is that they're going to think you're going broke. And amazingly to me, that farmer, when he sold those pieces of ground, I didn't hear people thinking that he was going broke. I mean, they were saying, yeah, it must be getting tough for him, but he didn't, it was just interesting. I've tried to kind of follow some of how he did things.
Yeah. So, fortunately, we have some similarities to the 1980s now, with, land prices are kind of going up the last few years. We've seen interest rates start to creep back up, and inflation obviously is an issue right now. So people are starting to compare it a little bit to the 1980s. But I'm just curious, and you may have already hit on this, Don, but for a farmer that's out there now that didn't farm during the 80s, as we're looking at potentially similar situations, what one piece of advice would you offer that farmer as we stand on the edge of this?
You want to get interest locked in as reasonable as you can, and the window is, we're into higher interest rates, but we know it can go nuts. I don't think it'll go into the teens, and I certainly hope not, but there is always the possibility that it can go on higher. The other thing we're doing, we're just buying everything ahead that we can, and because when during inflation times, things are higher next week than they were this week. So.
Yeah. So I guess one last question for you, Don. You already commented on the sleepless nights of trying to work through some of the financial issues. Any further comment on the emotional strain? And you talked about the people that you saw when you were on the land bank board. Any comment or words of advice in terms of the emotional strain and some of the stress that producers can feel during those kinds of times? Or
probably if they can find somebody who's a good listener and reasonable, has a just somebody they can open up to. I think that helps a lot when you can talk it through, and doesn't change anything, but I think it helps your attitude. That I think that's really important. It's a it's a ringer like you can't believe, because from day one, I've wanted to be a farmer, and my guidance counselor told me what a dead end job farming was. You'll never amount to much. And we put a pretty amazing operation together, and we'd have she'd be shocked at what our net worth is. I can't find anything that's more fun than farming. I don't care, any vacation, whatever. I count the days down until I can get back to really having fun, and that's farming.
Well, you can see that in you, Don. I appreciate that. So, Well, thank you very much, Don. Unfortunately, I could carry on this conversation a lot more. I appreciate your time, and we'll have to finish this now. Thank you so much, Don, for joining us. And I also want to thank Krista for joining us as well. I think this was a very informative discussion, and I hope a lot of people can gain some things out of it. Anybody on watching to get more information on this webinar and others, please go to our webpage, www.nefb.org, and you can find this webinar plus others on topics relating to farm profitability. So